So if I look back last year, it was a pretty bruising year. There was nowhere to hide. Equities, bonds, really, really trashed.
Yeah.
Wealth preservation was hard to do. We've had a sugar rush at the start of this year.
Yeah.
Is it too soon?
I don't think it's too soon per se. It is too soon to kind of talk of a trend, and it is too soon to talk about inflection. We do think 2023 is the year of inflection. Just go back last year, the war, the sanctions, the energy crisis, supply chain still faltering. I do think that the opening up of China, the impulse it gives to consumption in China, energy need, commodity need in China as well, I do think it's a very good signal. It will be supportive of a momentum, but the true inflection point we have not kind of seen yet.
The natural corollary to that is you as a house were way ahead on your call on China. You've reaffirmed it this morning. Is that movement from China, has that been reflected by the clients? Are they much more active in taking China risk?
Well, we've seen more activities, but we have certainly advised them to go long on China and to be overweight on China. That's what we came out with on time, I guess. I think we were all a bit surprised as to the speed at which China opened up, but I think. Advising the clients, and they really have come, and you know that from the third quarter, clients in periods like this need more and more advice. They really come to me, I'm talking to them, and they're saying, well, okay, help me reading these data, help me reading these trends, where should we go? And basically they put a lot of money with us to manage for them, right, in the third quarter.
And are you saying cash first, reflect and wait for a pivot? Or are you saying actively deploy, but judiciously? Which is the narrative for you?
We're still cautious as to the balance that you bring, and but there is moments to invest. There is absolutely moments to invest.
The other big debate is this: peak inflation, peak rates, and peak liquidity. Now, there's two bids there, and there's one offer.
Yeah.
If I look at the inflation narrative, the consensus is building peak inflation, and it will drop precipitously. Are you expecting a precipitous drop in inflation?
We are expecting that every month we will see a further decrease. I think that inflation at higher rates than what we're used to is here to stay. And there's a reason for that. If we truly look at what has happened to us in the world over the last 3 years, we do think that we're going into the era of security. It's energy security, it is about food security, it's about technology security. For that, part of the supply chains that we are still dependent on will have to be rolled back, which basically means you bring labor back, you have to invest. The energy transition is still at its infancy, at its start. Lots of investments will have to go into becoming less dependent on energy from other countries. So I do think that inflation will be higher than what we are used to in the past. So it will not come down to the 2% that we are used to. So we'll have to work with that, but it will decrease from here.
To finish off with the macro then, if it's higher inflation than we're used to, then Ralph, the corollary to that is higher interest rates for longer. Do you think we make it to 5% and over 5% and stay there 2023?
I actually think that it will peak around in dollars, right?
Yes,
around
dollars.
5%. Euro around the 3%. Swiss franc around 1.5%. And then I do think that they will come off the policy of hiking further, maybe stabilizing, see what damage it brings to the economy, and then lower again.
So that's whether they can deliver that soft landing in the States. Let's talk a little bit about the future and the growth, because wonderful headline: UBS is not buying Credit Suisse. No shock, but nor are you in acquisition mode. What goes through my mind between the chairman and the CEO? You're full bull on China. You told me that last year. Colin, it would sound, is full bull on America. How does that live together? Where will you invest more to grow, China or the US?
We've been very clear from the start. When I came out with my strategy 2 years ago, just over 2 years ago, we said, it's a barbell, right? So we will focus on Asia, that's where entrepreneurial growth will be, including China, and we will focus on the US because that's where entrepreneurial wealth growth is as well. So from the beginning, we've said there was a two-pole strategy here in terms of growth supportive. Clearly, China wasn't there from a COVID perspective, but long term, we know that that's where you need to be. And in the US, we're already very large as well, and that's what I've said from the beginning as well. That's where we need to continue to invest, which is what we did.
And that investment scenario, if I look at the cost to income ratios in the United States, they're high. They're high relative to everywhere else for you, around 80%.
Yep.
So this is a bit of a roll of the dice. If you're going to grow in America, you're going to have to spend and look large. Are you prepared to do that with a cost to income ratio at 80%?
Yeah, we have been very clear on our commitment to the US already from the start, a year and a half ago, as to what it is that we need to do. First, we need to grow the scale. Second, we need to support our financial advisors with much better digital tools. We need to develop our banking product offering as well on both the loan side as well as the deposit side. And we need to invest in digital also in order to help scale for clients to really access some of the information themselves. And we're launching some of these products as we speak.
Are you going to be able to then buck the global trend? Goldman's are cutting jobs. Other European houses are cutting and reviewing the fat of the land. From what you're saying to me, you're in expansion mode. Are you in full hiring mode and not a retrenchment mode?
We're not in retrenchment mode. We're also not in full hiring mode. We are hiring what we call for critical jobs. We are in a growth mode. I'm sorry to say, and we are a global wealth manager. That's where we see the growth. We see it in Asia, we see it in Asia Pacific, we see it in the Middle East. We are hiring, absolutely, because we have the momentum. And you've seen the third quarter results.
Yep.
On asset management, net new money coming through 18 billion. On net new fee generating assets in wealth management, just over 17 billion coming through. You see clients put a lot of trust in us on this one. So we're really bucking the trend if it comes to growth in wealth management and asset management.
Do you think we'll buck the trend, Ralph, and not have the classic recession that you and I would have lived through in various cycles? Are we going to skirt a recession in Europe? We haven't touched on that. Will we skirt a recession in Europe?
If there is going to be one, it's going to be a very short-lived and mild one.
And in terms of the wealth that comes into you, the inflows that come into you, and we'll dig into this a little bit more in 2 weeks, but that inflow that we saw, has there been a material inflow from the Credit Suisse debacle?
I was giving you the numbers third quarter.
I know.
It has nothing to do with Credit Suisse. All has to do about our own strength, how we deal with our clients. Our clients put so much trust in us. I go out to clients all the time. They really want our advice. We have a credible offering. That's what we're investing in. They know that wealth management is what we do. It's not what we also do. This is our core business.
And to make those inflows that we talked about stick, is it leverage? What is it they really want? Is it product, alternative product? Is it leverage, or is it credit? What is it that drives them to stick and hold with you?
It's the trust and the relationship with the advisor for sure. It's good investment advice, and you know that our CIO is really good at that. His strategies have worked all the time. He's also calling out the area of security. He sees it very, very clearly as to where things need to go. It is about private markets for sure, still, and it's about sustainability.